And welcome back. As mortgage rates nearly doubled in the first 7 months of 2022, the popularity of mortgage rate buydowns also grew tremendously as home buyers looked for ways in order to reduce their monthly housing payment, and home sellers offered it to home buyers as the housing market slowed dramatically. But because these loan programs only offer a temporary reduction in your housing payment, what will happen to these homeowners once their rate and payment increases? On top of that, what impact will this have on our US housing market this year? So in today's video, I'm going to share exactly what a mortgage rate buydown is, how often they were used, the pros and cons, as well as my advice for you guys as well. I'm excited to share this video with you guys. And of course, if you guys get any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Of course, a lot of research went into making this video, so I appreciate your support as well. Of course, I appreciate you for watching today's video as well. With that said, let's begin today's video. So first, what exactly is a mortgage rate buydown? According to Freddie Mac, it says this allows home buyers to reduce their interest rate for a limited period. The size of the reduction and the length depends on the type of mortgage. For example, nearly 2 out of every 3 recent temporary rate buydowns was a 2/1 or 2/1 buydown. According to crosscountrymortgage.com, it says a 2/1 buydown is a loan program in which you reduce your interest payments for the first 2 years of your mortgage. So for example, if you opt for a 2/1 buydown as a home buyer, your interest rate is reduced by 2% for the first year, and in the second year is reduced by 1 percentage point. By the third year, the interest rate goes back to the original interest rate of the loan. So with a 2/1 buydown, your interest rate and of course your housing payment gets reduced in the first 2 years of homeownership. And as Cross Country Mortgage explains here, it says a temporary buydown is a closing concession available for primary and second home purchases. It enables borrowers to have a lower interest rate for the first 2 years of purchase and ease into their mortgage payments. That's only for a 2/1 buydown. There's other programs available as well, such as a 3/2/1 buydown, in which the first year your interest rate is reduced by 3 percentage points, in the second year by 2 percentage points, and by the time we hit the third year, we have a reduction by 1 percentage point. And then in year 4, your interest rate goes to the current rate that was available, or the rate you locked in when you bought the house. As Freddie Mac explains here, this is an important distinction here, which is much different compared to the Ninja loans we had back in 2008. It says no matter the type of buydown, lenders must qualify the home buyers at the full interest rate. So they're qualifying you for your loan when you're buying the house based on the full interest rate and not the reduction in the first 2 to 3 years, depending on the length of your reduction in your housing payment here. This research from Freddie Mac is between January of 2022 through June of 2023 with the following criteria here. This is only for purchase loans and not refis. On top of that, this is only for 30-year fixed rate mortgages and also for conforming loans, and of course, owner occupied as well. One thing they noted here in this article here, they stated that buydowns were far less common on non-owner occupied properties. In other words, properties that are going to be investment properties in order to rent out. So the vast majority of people using these buydowns are people who are using it to buy a house to live in. Let's talk about some trends in these rate buydowns over the past year or so here. It says in the second half of 2022, the share of temporary buydowns spiked when, of course, rates increased as well to over 6% for the first time since 2008. Though the surge in temporary buydowns has since abated somewhat or has reduced somewhat, the increase in buydowns may signal a willingness by home buyers to pay more over the life of the loan in order to lower their monthly mortgage payments in the short term, at least for the first several years of the mortgage. So they go on to say here that they found that your average interest rate is actually higher compared to a conventional 30-year fix, for example. It says there may be a trade-off. Freddie Mac research based on the data from June 2022 through June this year shows that homeowners with temporary buy-down options received interest rates that were 15 basis points higher than average. So an increase of 0.15 percentage points higher than the average rate that people are getting. This implies that by choosing the buy-down option, borrowers may end up paying slightly more money throughout the life of their loan. They go on to say here that the increase in your average interest rate is actually not a big surprise though, because lenders may have to make up for the fact they're giving you a great rate for that teaser rate here, and therefore they have to offer higher upfront charges, a higher rate, or both. And by the way, this cost to cover this difference in rates is normally paid up front by the borrower, the home builder, or the home seller. All right, let me share an example regarding this buy down rate. Let's talk about a 2-1 buy down, for example, and how that's impacting average monthly housing payments for home buyers. So look at this. So when buying a $450,000 home, putting 20% down, let's just say you're buying a house at a 7% rate. Your P&I payment of principal and interest will be just under $2,400 per month. However, though, if you're using a 2-1 buy down, again, in the first year, your rate goes down by 2 percentage points. So look at this at 5%, again at $450,000, putting 20% down, your monthly housing payment is $1,932 per month, and not the $2,395 per month. That's year number one, about $1,900 per month. In year two, based on a 2-1 buy down, your housing payment gets increased slightly to $2,158 per month based on a 6% rate. Remember, in the second year, your rate decreases by 1 percentage point with a 2-1 buy down. Then in year three, your rate goes back up to the rate at 7% to $2,395. So to summarize this, in year three, after your temporary rate expires, your housing payment would be $237 more per month compared to year two, and a whopping $462 more per month compared to year one. These type of mortgage rate buy downs have been particularly popular amongst home builders in order to entice home buyers to buy their houses, especially in the last half last year. Now, I actually did some research this morning regarding are there any home builders right now still offering these rates? And I found they actually are, but for the most part, what I found was a reduction in your 30-year fixed rates. So for example, according to Lennar, for Central California, and these are only for move-in ready houses, and also there's some other stipulations here as well, but they're offering a 30-year fix at 5.625% rate. Also, Pulte Homes is offering at 5.5%. Again, there's some finer details here regarding who qualifies and who doesn't, though. Most of these, by the way, are for people with exceptional credit and also for move-in ready houses. And of course, you have to sign a sales agreement very, very soon and also close on that house very soon as well. Also, I found, Taylor Morrison offering at 5.99%. Based on my research though, this varies quite a bit depending on the area and also the community as well. But just interesting to see that builders are still offering incentives for home buyers right now, especially regarding a 30-year fixed rate mortgage. Freddie Mac also provided the percentage of people using mortgage rate buy downs over the past year and a half here. So the blue line right here is the share of people using a mortgage rate buy down. And the green line is your average rate or average mortgage rate. So as average mortgage rates increased from the low 3s to the 5s and 6s, so did the popularity regarding this buy down rate. So for example, in January 2022 through June of 2022, it was virtually non-existent here. But then we saw a slight increase. But by the time we hit October, we saw giant increases in the share of people using mortgage rate buy downs. And the peak was set back in December last year at 7.6%. Ever since then, it has been decreasing. And as of June this year, according to Freddie Mac, the share is at 2.8%. Also, according to Freddie Mac, it says temporary buydowns are concentrated among a few non-bank lenders. It says, in fact, between June 2022 and June this year, only 12 lenders were responsible for 80% of all temporary buydowns. They also looked at the percentage of loans that were funded between June last year through June this year by state. It says here they observed a higher share of temporary buydowns out in the West, particularly in Utah, Colorado, Idaho, and Arizona. Perhaps this is because of the mix of lenders or a higher share of new home sales in those regions. And here's a map showing just that. The share in Utah was 7.1%, in Colorado at 6%, Arizona 4%, Nevada at 3.8%, Idaho at 4%, whereas in California at 3.2%. In contrast, look at Vermont. The share there only 0.8%, New Hampshire only 0.6%, and Florida at 1.3%, and Texas at 2.6%. Freddie Mac also stated the following here. Given the limited volume and the requirement that borrowers need to qualify at the full rate, temporary buydowns seem unlikely to be a meaningful source of additional buying demand. Now, I also want to share my own thoughts regarding this as well, because I want to share some kind of pros and cons regarding this program here. So based on my analysis, or my opinion here, I should say, it appears that this should not have a substantial impact on our housing market right now. But what I'm more concerned about right now is that some homeowners may not be able to pay their increased rates or increased housing payments once their temporary rate expires. That is my concern going forward here. A buydown is only a temporary, typically 1 to 3 years. And the benefit, of course, of a 2-1 buydown, for example, is that it reduces your housing payment for the first 2 years. However, though, it goes back up to the full rate in year 3. If your income goes down or if you lose your job, then I'm kind of curious or kind of concerned regarding the impact regarding those homeowners and, of course, our housing market as well. And of course, for someone who does take on these temporary reductions in your housing payment, if they lose their job or they have a reduction in their income, that of course could end up with a very bad situation in which they cannot afford their housing payment. So for example, buying a $450,000 home, putting 20% down at the current 7% rate in a 2-1 buydown, in year 3, your temporary rate will expire. Your payment would be $237 more per month compared to year 2 and $462 more per month compared to year 1. Therefore, it's very important to consider these increases when deciding if a rate buydown is for you. Also, as a note right there, not all lenders offer a buydown, and of course, the terms of those loans can vary quite a bit as well. So my advice for you guys is to do your research. Of course, a benefit is that this is very helpful for home buyers who want to buy a house and reduce your mortgage payment on a temporary basis. This is also beneficial to home sellers and home builders who are trying to sell their houses as well, because they can offer these loan programs, which of course will entice home buyers to buy their houses as well, which is particularly beneficial for home sellers and home builders when we have a buyer's market in which buyers have an advantage over home sellers. Now, here's my advice for you guys. Consult with a loan professional regarding these scenarios with you guys. Talk about the costs involved and, of course, your changes in your housing payment over the next several years. Another thing that I'm worried about is that some home buyers may have used these loan programs in order to minimize their payments while banking on the fact that they will be able to refi before their rate increases to the current rate, or I should say once their rate expires or their temporary rate expires. There's no guarantee that rates will fall so that you can actually refi, or that you will be able to refi or qualify for a refi. Therefore, you may want to consider a more traditional 30-year fixed rate mortgage rate because your principal and interest payment is fixed over the life of that 30-year loan. But of course, I'd love to hear from you guys as well. What are your thoughts regarding these buy downs, and what impacts will this have on our U.S. housing market? please leave me a comment below. I appreciate you. Hope you have an awesome day, and I'll see you in the next video.